Welcome back, everyone. Grab a coffee, because today we've got a seriously fascinating explainer lined up for you. We are digging into the May 2026 analyst report from DSC Securities all about Vietinbank. You probably know them by their ticker, CTG. We're going to take the raw data and research straight from DSC's desk to figure out exactly what's happening under the hood of one of Vietnam's biggest financial giants. All right, let's just dive right in.
So right out of the gate, I want to talk about one specific number, 18%. This is really the whole hook of the DSC report. The analysts have slapped a strong buy recommendation on CTG, and they're projecting an 18% upside with a target price of 42,900 dong. But you know, any analyst can just throw a buy rating out there, right? What we actually care about is the why. And the why driving this 18% is this brilliant little financial paradox that we're going to unravel together today.
And honestly, the tension here is wild. Think about this. In the first quarter, CTG's pre-tax profits literally skyrocketed. They were up 63% year over year. I mean, that is a massive, almost unheard of jump. But at the exact same time, their credit growth, basically the amount of new money they're lending out, was totally sluggish. It was just 1.7% year to date, which is lagging way behind the industry average of 3.2%. So the big question is, how on earth is a bank printing so much profit when they're barely growing their loan book compared to everyone else?
Well, to figure that out, we're going to walk through 4 quick things. First, recommendations and overview. Second, the profit surprise. Third, asset quality. And finally, CTG stock valuation.
Okay, let's kick things off with Section 1, Recommendations and Overview. So just to level set here, CTG is an absolute state-owned powerhouse. They're sitting pretty as the second largest bank in the entire sector by total assets. Their bread and butter has always been corporate lending, though they are trying to bring in more retail customers lately. Now, historically speaking, DSC points out their profitability has been, well, kind of average. But they have this one superpower, an ironclad reputation for insanely high asset quality compared to the rest of the pack. Basically, they play it safe and they play it smart.
Moving right along to Section 2, the profit surprise.
Okay, we gotta ask the obvious question here. If CTG isn't pushing out loans as fast as their peers, how are they raking in so much more cash? Like, where did a 63% profit jump actually come from?
Well, it all boils down to 3 letters. NIM. Net interest margin. Put simply, this is just the difference between the interest a bank makes from lending and the interest it pays out to its depositors. It's basically the core engine of how a bank makes money. If your NIM expands, you make more cash on every single dong you hold, even if you aren't aggressively pushing out new loans. And get this, CTG's NIM surprisingly recovered to 2.8% in Q1, totally defying the downward trend we're seeing across the rest of the banking sector.
So how did they pull off this margin expansion? It was basically a genius 2-step move. First, their asset yield ticked up by 0.3%. Why? Because late last year, they strategically shifted some of their credit room over to long-term loans, mostly for home buying, which naturally pay out higher yields. Second, their cost of funds barely moved, and the reason for that is kind of crazy. The state treasury basically parked an ocean of cheap capital, over 51 trillion dong, right into CTG's lap. So, higher yields on loans plus incredibly cheap funding equals a surging net interest margin. They optimized what they had perfectly. Which brings us to Section 3, Asset Quality. This is how they defend those profits. You've got to hear these metrics. CTG's non-performing loan ratio, the NPL, is sitting at a super manageable 1.02%, but the really jaw-dropping number is their bad debt coverage ratio. It's at 167%. Let me put that into perspective for you. For every single dollar of bad debt they have on the books, they literally have $1.67 locked away in reserve to cover it. It's a ridiculously thick safety net against, well, any potential economic defaults.
And if you track this over time, you can see they've been consistently building up this coverage ratio since late 2025. I mean, while the rest of the industry was kind of panicking over rising interest rates and bad debts early this year, CTG was just quietly building a fortress. They aren't just making higher profits, they are heavily insuring them.
All right, finally, let's hit Section 4, stock valuation. Let's talk about that price target.
So DSC values CTG using a price-to-book method, which is essentially measuring the market value of the bank against its actual net assets. Given their massive size, that rock-solid asset quality, and the expanding profitability we just talked about, DSC justifies their target price of 42,900 dong using a 1.5 times PB multiple for 2026.
Right now, it's trading around 1.5 times its book value, but DSC's forward estimate for 2026 is actually much cheaper, sitting at 1.27 times. That is well below its 5-year historical average. And honestly, that massive discount, that's exactly where our 18% upside lives.
But wait, there's a serious plot twist here. The 18% upside isn't just about good banking mechanics. There's a major catalyst waiting in the wings that DSC says isn't even fully priced in yet. CTG is expecting a sudden, massive windfall from the transfer of their Siputra Tower real estate project. We are talking about a project with a total investment scale of 10,000 billion dong. Management expects to finalize this in Q2 of 2026. This sudden wave of extraordinary income is going to give them even more room to boost profits, or just pad out those bad debt reserves even further.
So, I'm going to leave you with this to chew on. You've seen the numbers. Yes, CTG is definitely dealing with the same slow credit growth as the rest of the industry right now, but they're fighting back with incredible margin expansion thanks to that cheap state funding, an ironclad 167% coverage ratio, and a multi-trillion dong real estate catalyst just waiting to drop. So here's the big question. Is an 18% potential upside worth riding out the short-term banking headwinds? Take what you learned today, pull up the charts, and decide for yourself. Thanks so much for joining me for this explainer. Keep learning, and I'll see you next time.